Get ready to hear the only show in existence that is dedicated to taking the mystery out of real estate investment financing once and for all. Real Estate Investment Finance Radio is on a mission to find, vet, and fully explain the best financing options for virtually any real estate investment and connecting you directly to them. From 1 to 4 unit fix and flips to very large multifamily and commercial financing and everywhere in between. Whether you're an investor or a broker that's looking to help investors, this show is made for you. And here's the man behind that vision, your host, Lane O'Brien.
Hey all, thank you for joining me. Today I'm speaking with a lender that has some of the most comprehensive and competitive programs that we know of for very small investors all the way up to very large institutional investors and everywhere in between. Stephanie Casper is with CoreVest Financial. She and I have worked together for quite some time, and she is a real go-to for me and my clients for many scenarios as we will be discussing. Stephanie is a seasoned professional with a background on the equity side prior to her position as a loan officer, which gives her a unique perspective and advantage when it comes to making deals work. CoreVest specializes in residential investment financing nationally. They have long-term loans, bridge rehab loans, ground-up construction and portfolio or blanket loans, and their programs span across the whole spectrum, ranging from 1 to 4 unit properties to extremely large multi-unit properties, and are among the most competitively priced you're going to find anywhere. So this show is literally for almost anyone that owns or would like to own a residential investment real estate in whatever form you can think of. And as always, you'll be able to connect directly with Stephanie and her team right here from the show notes page. So with that, sit back and enjoy the show. Hey, Stephanie, how's it going?
Great, Lane. Happy Friday.
Thank you so much. It's another beautiful day down here in Tampa. And
it has finally stopped raining here in Southern California. I've been just getting ready to build an ark, actually.
That's terrible. Yeah. What part of Southern California are you in?
So our main offices are based in Irvine. I actually am fortunate to work remotely from a home office that's about an hour north of Santa Barbara on the Central Coast.
Okay, wow. All right, yeah. So that song, "It Never Rains in Southern California" is not true.
It is not true. This winter it has rained constantly, yeah.
No fun.
No. Although we needed it, so it's a good thing.
Yeah, that's good. Well, we're relocating up to Charlotte, and I was up there the past week, and it was cloudy and rainy pretty much the whole entire time. So I'm thinking maybe I'm making a mistake. I don't know, but
I think in about a month, it's like Charlotte could not be a more lovely place to live.
That's what everybody tells us, but they're not lying to us at this point. So no, we're actually pretty excited. It should be pretty. Yeah.
I've spent a fair amount of time up there. One of my biggest customers and a relationship that I had from prior to joining here, they're based in Charlotte, up on Lake Norman, and I love it out there. It's gorgeous.
Yeah, that's kind of where we're looking actually, hopefully to buy a house is up on what a great place. So yeah, we'll see.
Very cool.
Yeah, so let's kind of just jump in here.
Sure.
CoreVest. First, how long have you been kind of in the lending industry at various, I know you've worn different hats, but just kind of talk a little bit about your history in terms of what you've done and how you got here today.
Sure. So I've been in real estate in one shape or form since graduating from business school in I don't want to date myself. So since graduating from business school, and I after business school, I joined GE Capital in their commercial real estate group for a period of time, just working on, and I rotated around to a number of different businesses within the GE Capital world that most of them don't even exist there anymore. But and that was primarily on the equity side. And I had been on the equity side for probably a decade, working on structuring interesting types of deals or underwriting, the feasibility of hotel projects with Marriott. So I kind of moved around a lot and then landed at a group in Southern California that I wore a lot of hats and we structured and sourced all kinds of real estate deals, hairy, complicated types of deals. And through that process, we worked with some banks in the Southeast, helping them kind of work through their troubled real estate portfolios. And that's really where I started to get a better understanding for the lending environment during the downturn. And after that, I moved to CoreVest. And so I've been with CoreVest, which was formerly called Colony American Finance. Some people may know us by that name. We had a name change a couple years ago due to an ownership change. But I joined CoreVest, and my experience with CoreVest was really my first time as a lender. When I joined in 2015, I was actually running the bridge lending business for the company, so all of the short-term debt. And I transitioned out of that role because of a personal life sort of move up to the Central Coast that I mentioned earlier in support of my husband's career, and wearing a sales hat now for the last, I guess it's been 9 months now. So I've been now about 4 years like truly in lending, but in real estate finance in one shape or form for probably almost 15 years.
Wow. Yeah, I mean, and the thing is, the thing I love about the whole industry itself is just it's so vast, and there's, I say this a lot, you can learn something new every single day. I've been doing this in various forms for almost, I'll date myself here, almost 20 years, and it's amazing how much you can learn and how much you don't know. And when you start realizing how much you don't know, it might be a little scary, but it's a great, fascinating industry, and I can't imagine doing anything else. So
yeah, it's cool, and I think what is interesting, so many people are in lending and have always been in lending, and that's not been my experience. I was really on the equity side, but I think that has been super beneficial for my kind of progression in this space, because I don't view the world just through the lens of sort of risk mitigation, which is often how lenders get kind of pigeonholed or judged, I guess, and more so I can kind of understand the equity side and how an investor is thinking about their deals and underwriting their deals, and in a way that's a little bit different from perhaps how a lender does. So I think that's been very beneficial for me career-wise, and so I like to kind of talk to investors because I get what they're doing from that side of things.
Yeah, yep, and they definitely, it's definitely two types of vision, one from the investor and one from the lender.
Yeah.
And working in between the two is where you kind of you really do have to see both sides. So that's
sure.
Great.
Yeah, agreed. So.
And you were telling me before the call, you're pretty much 100% in sales now.
Yes.
How do you like that side? Like, how do you fare over on that side?
Yeah, it was a scary leap because sales has been an element of every job I've ever had, but it hasn't been the job. So it's just a sort of different world. What I loved about pretty much every role I've had prior to being in this one is the customer interaction and solving problems, or coming up with strategies to sort of solve whatever situation a customer might have, whether that was a problem they had when I was managing the bridge business or a challenge with structuring the equity for a deal. I always liked that interaction and tend to be relatively chatty. So I am enjoying it a lot. It's been an adjustment and a huge education, but I'm liking it quite a bit. And it's kind of fun to just be in charge of your own destiny, I think, from a sales perspective versus sort of tied to managing other people and that sort of thing.
Yeah. Yeah. And, I think you nailed it there. I think sales is really the wrong term to use, especially in this business, because really what we do is solve problems. Mm-hmm. And I always try to look at, when I have a lot of clients here in the Tampa area and around the country, and whenever I'm working for a client, I put myself in their shoes, and I legitimately, every single time, I believe that I'm working on their behalf to get them the best possible solution for whatever it is they're trying to do.
Yeah.
And therefore, it's not sales. It's all you do is you provide an answer, and that's what I think is so rewarding in what we do, because you really can help people that otherwise couldn't figure this out. Don't have the bandwidth or whatever to figure this out. So it's pretty cool that way.
Yeah, and I think what we're doing in the types of loans we do, it's not a one and done sales opportunity. It's much more of a consultative sort of relationship as you're solving one situation, but then whether that's to finance some long-term rentals, or if it's how do I grow my rental, there's always there's always another opportunity after the first one. So as somebody in sort of sales, I'm always thinking about the bigger relationship versus just the one potential task at hand or opportunity at hand. And I think that's sometimes different. I think salespeople tend to get a bad rap and get lumped in this like it's a one and done mercenary type of role. And I just don't view it that way.
Yeah, no, that's because you're one of the good ones. That's yeah. And sometimes you have to be their psychologist. It's so funny because I have a desk here, and sometimes I'm like putting myself down on the desk and talking to these people as we're going through a tough closing or whatever. But it's awesome. Again, I love it. So let's go into let's talk about CoreVest.
Sure.
And I did know you guys back when you were Colony America. So yeah, we did a lot of business back then. You guys became CoreVest, and somehow we ended up working together. I'm not sure exactly how that happened. And we've been doing some great things. We have a great deal going now that should be closing, I think, in the next, maybe this month or
early, either late this month or early April. I think the guys indicated they were looking to close the second week of April.
Okay.
When we had our kind of kickoff call.
Okay. And that's a deal that I helped some investors acquire about a year ago. 20, we'll just do a quick thing on it. It's 26 units plus about 12 townhomes.
Right.
And you're doing, and this will kind of lead into what you guys do, but you're doing a portfolio loan across the whole thing. And
that's right.
Allowing them to do one loan that's a kind of a takeout loan, and it made a lot of sense for them. So talk about CoreVest a little bit and what you guys do.
Sure. Yeah, so we are a private lender doing commercial loans for residential investors, and can be separated into sort of two main business lines. We have short-term financing for folks that are, buying to fix and flip, or for folks that are buying to stabilize, put in tenants, and grow rental portfolios or aggregate rental properties. And that's typically 12-month money. And then on the other side is our stabilized long-term debt, which is for folks that own one or more stabilized rental properties. So on and the sort of bifurcated, we have a single property rental loan for just your typical 1 to 4, very similar to sort of the agency financing that's out there, 30-year fixed type of loan. And then the portfolio term loans, which is what the deal we've been working on, is a blanket loan on 5 or more stabilized rental units. And it can be multiple properties, multiple states. In fact, oftentimes they're not just geographically concentrated. So we've been doing this since, I believe it's 2011 in our original phase, which was related to auction finance, and then became Colony American Finance in late 2014. And so sort of operating in our current form since then. Same leadership team with Beth O'Brien as our CEO. She came over from that auction finance business. And Ryan McBride, who's our COO, was one of the founders of Colony American Homes, which is one of the large public REITs that own rentals. They merged into I think it was like a reverse merger. I don't know exactly the structure, but over with Invitation Homes about 18 months ago or so. Kind of coincided with our separation and turning into CoreVest.
Okay, great. Mm-hmm. Okay, and so let's go through this kind of one by one. Let's take the first one you mentioned first. Mm-hmm. go into, if you would, what I always like to try to do here is to talk about somebody out there that's listening has a deal, and we want to understand who really would qualify, or what asset would qualify.
Mm-hmm.
What kind of asset would you like to see, and what's an attractive prospect for CoreVest? So the first question I always ask is, are there any states where that you don't lend in for either bucket?
So for our credit lines and rental portfolio loans, we are nationwide with a few exceptions. We have licenses pending in Nevada and Minnesota, and we do not lend in North Dakota and South Dakota. For the single property rental loan that I mentioned, it is exactly the same, with Arizona as another non-lending state. So there are 3 states on the single property loans that we cannot lend in, which is North and South Dakota and Arizona, and then pending licenses in Nevada and Minnesota.
Okay, very good. And we'll put a note up on the show notes page for anybody that's listening that might be in one of those states that you're not currently, so that whenever that changes, we'll keep that updated, as a lot of this stuff does continue to change. So check the show notes if you're interested in one of those states that you're not in currently.
Sure.
You might be. So, all right. So let's go to that single unit loan program. Mm-hmm. First kind of thing I have there is it only long-term, or do you also have a purchase and rehab loan that you could do along with that?
Yes, so it's both. We offer both long-term for stabilized rentals on the single property loan. It's a minimum loan size of $67,500, and it's a 30-year fixed recourse loan. On the bridge financing side, we can do single property bridge loans at a bit higher minimum threshold, at the 125 range, so is where our starting point is from a financing perspective on the short term, and that's a 12-month term, also recourse.
Okay, so let's go, Leah, let's take them one by one then. So the purchase, the rehab loan, a minimum of 125, I assume that would be a total combined loan, so you're going to take your acquisition plus the rehab.
Correct.
Add them together. As long as you go over 125, you're okay.
Mm-hmm.
And so on that particular loan, are you lending purely upon the asset, meaning where we're seeing kind of the world sort of moving to is this ARV, after repair value. It's really the kind of hallmark for how the loan is put together in terms of loan to values and loan to costs and things like that. Just to kind of get into the weeds a little bit, what are the rules around what somebody can do in your program for?
Sure. Yeah. And this is the same, this also will go to the bridge line, sort of how we assess short-term financing and come up with an allocated loan amount or a loan amount per property. And we're going to look at a few things. We're going to look at what's the purchase price of the property, what is the current value, and then how much are you going to spend on fixing it, what does that rehab budget look like, and the as repaired value. So we're going to have LTC thresholds and LTV thresholds based on as is, as well as the total loan to cost, so rehab dollars plus purchase price, as well as the ARV LTV. So it's kind of a 4-way test on both of those that looks at today and the future once that renovation is completed.
Okay, very good. And how active are you guys in that space? I mean, are you really, are you jamming over there in that space?
We are. I would say we rolled out our single property short-term financing. It was either 18 months ago or 2 years ago or so, somewhere in there. Whereas our primary lending business had been those credit line facilities for multiple properties over that 12-month period. And we recently acquired a business called Black Square Real Estate out of Salt Lake City. We had been working with them pretty closely for some other administrative support, but we brought their team in-house as well for additional capacity related to the single property bridge financings, and it's been booming. So we are seeing quite a bit of it. I think there's a lot of competition from hard money out there in specific markets, and those are guys that'll typically fund within a week, and we have a little bit more underwriting around it, but it's not materially longer. There's also an online presence of a few lenders that are doing this as well, but I think it rounds out our product offering, and we're seeing quite a bit of demand for it.
You are. Okay. No, that's, and that's kind of why I asked the question, because, we work with lots of different options and different lenders and things. So
sure.
I know you historically, the way I think of kind of CoreVest, and forgive me if I'm wrong, but I think that you offer very, very competitive programs, very competitive rates, some probably the most competitive in a lot of cases. However, you are a little more conservative than somebody might find elsewhere that might be willing to pay a little bit more for less of an exam.
And I think we are not a no docs underwrite shop. We're not that kind of lender. And while we're probably not as rigorous or conservative as your local bank or some of the big money center banks, we're definitely more conservative than hard money guys. So I often refer to us as medium money when I'm explaining, because our rates are less than hard money, but our underwrite is more than them, right? And then our rates are a little bit more than your typical bank, but our underwrite is a little less conservative. So we're sort of in the middle there.
I like that. Medium money.
Medium money, yes.
That's awesome. No, I was looking for a good way to describe you, because I think that's exactly, that's perfect as far as a description. So for the way I would translate that is, if I had a client come to me and I'm looking at their situation, one big thing is a lot of these other lenders that I'm kind of talking about here are somewhat limited in their states or their region, areas that they'll go to. So that's one big way you would win, I think, because you have such a large footprint.
Yes.
And then I would look at, if somebody is, fairly, I don't know how experienced necessarily, but somebody that knows what they're doing, that wants a little better deal, but maybe is willing and able to put a bit more skin in the game. There are some very high leveraged products out there now that are very expensive, but they enable someone to get into a property maybe with limited capacity. So, I would look at you as, well, let's try here first and see if this makes the most sense, because I think your option from a cost perspective is typically going to be better than most of what they're going to find out there, including in that rehab arena. So,
and I think we're not 100% financing kind of place. And in one of my past lives, I worked with this really smart guy who used to say that real estate investors ask the wrong question about debt. They ask how much can they get instead of how much should they have. And it really resonated with me, because the people that get caught are the ones that maybe take out way too much, right? And people do that for whatever reason from time to time. You need to do it. But there is a real cost to being over-levered, especially if there's a downturn, right? And I think we try to take an aggressive approach so that we're able to meet the needs of the market and the demands of the market, but still have a little bit of control. And look, I get that in underwriting, right? The amount of leverage you get is really is the number one sort of indicator of ultimate returns, right? How high you juice leverage. But sometimes people just don't think about the cost of being over-levered. So I think there are times where people have to get creative and find somebody that'll do very, very little down or none down, but that's not really our space. We're looking for guys that are going to be, or girls for that matter, who are, aggressive, but have some liquidity and can make that down payment.
Yep. No, and that's, those are great rules to live by. What got us into trouble back in 07, 08 is just what you're talking about. And I am sort of seeing those tides, not the same as it was back then, but definitely there's some over leveraging going on out there now, I think. And
yeah, I think there's a lot of capital looking for a home. Yep. and debt seems to be an attractive place to park it. For a while, it felt like it was a race to the bottom in rates and a race to the top in leverage. I would say probably 6 months ago, I felt that pressure from every direction. I think it's calmed down a little bit, and I don't know if that's a function of just debt markets in general. It doesn't quite feel like there's that massive race to the bottom anymore.
Yeah, I agree. I'm seeing the same thing over here. So I think what you're seeing is accurate. So a player like you, for somebody like me, might be a very, very good option, all things considered. So,
yeah, there's a couple things so I can't necessarily lend to a first timer, but first time meaning absolutely no real estate experience whatsoever. Right. If somebody has some other type of experience that's transferable skills, right? They're a realtor, they've been a contractor or something of that nature. It's a little bit different. We would take that into consideration. Typically, we're looking for 3 transactions. Someone has done 3, whether they own 3 rentals or they've flipped 3 houses, something of that nature.
Are you looking like the last 24 months, or if it's 3 in the last 5 years? Would that be?
Yeah, we don't, ideally it's in the last 24 months, but again, there's always exceptions to be made.
Okay.
So I don't want to discourage someone from saying, hey, I want to do this, or I have some of this skill set or these experiences, and I have good liquidity and good net worth and good credit, right, and a business plan, and from at least reaching out to you or me to sort of solve for see if there's an opportunity.
Okay.
Because we're in the business of doing deals, right? So if insofar as we can solve for it, we will try to.
Yeah, us as well. So that's good. So you let's talk then. Just kind of give me some parameters in the rehab loan. Loan to, let's call it loan to purchase, which would have to be equal to the current value, I would assume, or the current value should be greater in most cases for purchase. And then you have the loan to ARV, total loan against the ARV. So
that's right.
Yes. So let's talk about those limitations, because those are also important, and that goes right to the leverage that we're discussing.
Sure. Yeah. So on the acquisition financing for any of our short-term loans, we are financing sort of a lesser of test between 70 to 75% of the as-is value and 80 to 85% of the purchase price. Sometimes we can go a little higher with like really seasoned, super institutional kinds of guys and certain markets where the fundamentals are still there. But we're starting to see a little bit of a prolonged timelines on flips. So we're being a little bit more judicious about going all the way to, call it 90% of cost or something like that on the buy. Okay. And then on the total loan to cost, we'll go to typically 85 to 90, subject to a 70% ARV LTV test.
Okay, which is that's completely in line with what's most standard out there in the market.
Yeah.
I mean that's a great. It's a very good loan. And so the question I have, when you're establishing that as is value, are you ever challenged as far as coming up with that value because of the condition of the property typically is not up to snuff? And, I just think that can be a little bit of a challenge. I don't know what you're seeing on your side.
Yeah, sometimes it is. I think when it's the biggest challenge is where somebody started work on a property and then stopped. Right. So it's, the kitchen's ripped out or something of that nature. That's in midstream. It's hard to get an as-is value. I'm not going to lie; those are the toughest. Most of our guys and girls are buying properties even today, still targeting 10 to 20% below market, because I think the lipstick flip is kind of gone. It's hard to find those now, and so they're having to do more value add renovations with a few markets as exceptions still. And so they're still looking to pick stuff up below market value. Because I think the borrowers that we have, the customers that we have, they're in their very specific market and they know what stuff is trading for once it's been fixed up. So we are once in a while limited on the LTV side at the as is. I think it's happening more and more because values have come up and the bargains aren't quite as readily available. But I think for the most part, we still see loan to cost limitations as the limiter on the acquisition.
Okay, that's good to hear. And one question I think you said, but does this program, this is only for 1 to 4 units? You don't have this available for a 6 unit or a 10?
Oh no, we absolutely do. On the short-term financing side, we can finance even up to very large multis. Actually did very interesting deal a little over a year ago on portfolios of some large distressed multis in Florida. Call it up, I think the largest was 285 units. And we financed the acquisition and renovations while they restabilized the property before they put it into, long-term debt.
Okay.
Mm-hmm.
Okay.
So on the short-term side, for sure, we can finance anywhere from and I guess that's probably worth mentioning just in general. We will finance all types of residential uses, including large multis, with a few exceptions. No manufactured homes or mobile home parks. No student housing where it's a per bed rental. Right now, we're working through that a little bit, but rentals that are catered to students, but not that sort of university style per bed. That's tough for us to get done. And I think that pretty much covers it as far as assets that we can't finance.
Okay, so let me drill down a little bit on that, because I've done a lot of that kind of business, and honestly, I don't think I just didn't recall as we're sitting here that you did them past 4 units. So we absolutely do. And on the long-term side, so on the bridge side, absolutely. As many units as you can send my way, we can finance them. On the longer-term side, the products are sort of bifurcated. So we have the 30-year fixed that's just for a 1 to 4. And then once you hit 5 or more units, that would fall under our portfolio term loans, which are the 5, 7, and 10-year term. Those are just for the stabilized product. And again, I think on the large multis, there's a lot of very attractive pricing out there for big multis, long-term debt that we are not always the most competitive. But when you're talking about the stuff that's maybe not quite small balance commercial for the agencies, we fill that niche very, very well. Okay, that's done under, say that again, is that under your portfolio program? Like, in other words, if I had a 20-unit building that I wanted to reposition and go long-term, loan amount of, let's say, I don't know what your minimum is, but let's say 750, something like that. Would that be applicable for the portfolio, or where would you?
So this is where I'm going to take a step back for a second and address that. This is where our loan products support one another really well. So in the example that you just provided, if you were buying that property and it needed some love and attention, it wasn't quite stabilized yet, you wanted to spend 6 months fixing it up, actually kind of like the Valdosta stuff we're looking at, the 26 units, right? Fix it up, financing that on a bridge loan, whether it's via a line of credit commitment or a single property bridge loan, such that we're financing the acquisition and the renovation piece while that stabilization is happening. That can feed really nicely then and be refinanced out into long-term debt with us as well via one of our portfolio loans. So a 5, 7, and 10 or 10 year, once it was at 90% occupied, work was pretty much done, we could refinance that on our portfolio term loans for sure. And there's a minimum loan size on the portfolio term loan of $500,000. So, on a 750 acquisition, 75% of purchase or something like of that nature, 75% of value would qualify there.
Okay. Oh my goodness. This is great, because that is very much in line or very competitive with and priced very, very comparably to the agency, the small balance that you just mentioned. And where I'm going with that is, for anybody that doesn't know, typically an agency loan like a Fannie Mae or a Freddie Mac for a multifamily, there are limitations in loan size. Number one, most lenders won't go below $1 million. There are scattered out there that will go down to 750, but it's getting harder to find. And it's a great program. But if you're serving it all the way down to 500, there's a lot of activity in that sort of size that, and I talk about it as an underserved market from financing, that we end up going to a small balance lender, which is fine, but the pricing is different, when you go small balance. So,
yes.
Yeah. I mean, that's very eye-opening. I'm going to ask you some more questions in a minute about that program.
Sure.
So
okay.
Let's circle back real quick. So you just said that we can go 1 to however many units as far as acquisition and rehab, including larger multifamilies, what have you. Are the rules essentially or roughly the same if it's a 1 to 4 unit versus a 80 unit?
Yes.
As far as that goes, limitations?
Yes, with one exception. So we have a minimum value property pretty much across all of our loan programs, with one exception, and that's the single property 30-year fixed rental of $50,000 is the minimum value on a property that we could finance today without getting an exception. Okay?
I understand. And that's an important, we want to kind of highlight that too, because this does come up pretty frequently.
Yes.
You're saying value of $50,000, not loan amount, because a lot of lenders go by
correct
minimum per unit
value.
Or higher value.
Yeah.
That's
value.
The loan per door could be lower than 50.
That's right. However, on a multi, we're not requiring them to be at 50,000 a door, right? We're looking for more like 30 to 40 per door. So that'll dial back a little bit.
And that's value, not loan.
That's value.
Yeah.
That's value.
Critical thing, actually, because a lot of people, again, a lot of lenders look at it a little differently than that, which I like.
Correct.
I like how you do it. Okay. So acquisition, the rehab, 1 to however many units is essentially, as far as the rules go, the loan to cost, loan to purchase.
That's right. Those rules are all the same. The rates are all generally the same between, just a regular 1 to 4 to a multi. Obviously a commercial appraisal and often title surveys and sometimes phase 1s are required for multis of size, right? Commercial appraisal always from once you hit the 5 unit threshold, you no longer can get a single family appraisal. So there's some cost differences associated because a commercial appraisal is just more expensive. And once we get to 20 or more units, we have to get surveys and phase 1s. And so there's some costs associated, but where we don't require those things on traditional SFRs. But otherwise, the parameters from a lending perspective are the same.
Okay. Yeah, this is great. And so I hate asking this question typically, but I'll just throw it out there. If you can give me kind of a broad range of where that program typically falls from a rate perspective as we speak today. I mean, we're rates trading in that program typically.
For short term, we're going to be 8 to 10% and 1 to 2 points, depending on location, sponsor experience, credit scores, etc., size of the line or loan. And then on the long-term financing, we're financing at or pricing at a spread to the applicable treasury swap. So I would say we're in the mid 5s to mid to high 6s for non-recourse. And again, it depends how high on the leverage spectrum you're going, sponsor credit, size of the loan or portfolio, et cetera. So figure those rates are sort of 5.5 to 6.5 and change, somewhere in there.
And you long term, just so because I kind of want to go one by one here, but so you're
Yeah.
talking about the single family 30-year fixed as well as the portfolio when you're talking about that pricing. Is that correct?
Yes, I believe the single family 30-year fixed ends up getting a little bit higher, maybe closer to 7. And bear with me, I am not the resident expert on the single property 30-year fixed rentals. We have a really awesome team that is expert in that because it's a little different from the portfolio lending. So I know enough to be a little dangerous or maybe very dangerous, but yeah, that one might end up being a little bit more expensive. Again, depends on sponsor experience and credit and that sort of thing.
Yeah, that's okay. And I think I've spoken to that gentleman over there too. So yeah,
I think you have. That's right.
So that's good. Okay, so let's finish up with the rehab question, and then I want to move over to the portfolio. But just to make sure, that's an interest only. It's a 12-month loan. There's no prepayment penalty. It's designed as an acquisition rehab loan. You can use it for almost anything in terms of residential acquisition and rehab.
Correct.
All the way up. So that's great. That's really great news for me, actually. I'm going to be calling you on some stuff I'm working on right now. So
excellent.
Yeah. All right. So let's move over to the portfolio loan. Let's start with just sort of a basic explanation for what that actually is, in case you're not familiar with the term, and then we'll take it. We'll kind of just drill through that. We won't spend a whole lot of time on this, but
okay. Yeah, so the portfolio loans are for stabilized rentals, meaning the portfolio of assets, 90% of the units are leased at the time that we close, and it's 5, 7, or 10-year terms, typically with a 30-year amortization. So there is a principal component to it, so it's principal and interest, and it's for 5 or more units and a minimum loan size of $500,000. We put a blanket mortgage across all of the properties versus one mortgage, one loan per property. And they're very similar to a CMBS style loan if folks are familiar with that. But instead of commercial properties like retail and industrial and office being the collateral behind the mortgages, it's single family or residential investment properties. And so the customer that works for is a broad range, right? It's anyone from sort of you and me, Lane, with our rental portfolio of 5 or 10 units that we've bought one by one over the last few years, and sort of it's our side gig, to very institutional, vertically integrated real estate investment companies that own hundreds or thousands of these properties. And we sort of finance everybody in between. Something that I get asked a lot is, well, what if I have, multiple equity investors? Can I still get a loan with you? And the answer there is absolutely yes. That equity structure or ownership structure is sort of the owner then of the borrowing entity, right? And so we can do those loans. We see a lot of that sort of fund structure or partnership or syndication. We see that quite a bit. So yeah, so the key other element of this is the underwriting on our portfolio term loans. It's an asset underwrite based on the cash flows that the properties are generating and their ability to pay the debt service. So we're going to underwrite to a lesser of some LTV number that we size and price to, and the debt service coverage ratio typically of a 1-to-0 debt service coverage. We care about the sponsor's income and ability to pay insofar as they're good guys, they don't have bad credit, they can demonstrate some liquidity and net worth, and that they've actually filed income taxes. But what we're really underwriting on the term loan side is the income of the properties in the portfolio.
Okay, very good. And not to go too far into the weeds here.
It's okay.
Quick question on just sort of what you said there in terms of the lesser of two, the debt service. I know that for personally, I know that because I've had some loans that I've presented to you that were sort of capped because of the debt service. So the loan itself could only go to, let's say, 60 or 65% of the total value of the portfolio.
Yes.
That's all that would be serviced by by the leases and the income. What is the maximum let's say debt service is not really an issue. There's plenty of income. What would be, in your experience, what's the maximum somebody could get? Now back to that leverage question, but what's the maximum loan to value typically on a portfolio?
Yeah, our maximum loan to value on the portfolio loans is 75%. Okay. Assuming that the cash flow covers. We are not in the business of cashing somebody out at 150 or 200% of their basis within, a very short period of time. It's sort of bad lending practice, in my opinion. Other people could probably argue both sides of that. So if a portfolio has been owned under 12 months, we will often cap it also at a 90% loan to cost. But again, that's sort of on a case-by-case basis. But 75 LTV is the max we can do.
So this is, I don't know if this is a curveball or not, but let's say, because this has happened to me, where there's a portfolio of properties that some were purchased maybe 2 years ago and rehabbed. Now there's a new value that's been established. But then there are other properties that might only be 6 months, recently purchased. How would you look at that and underwrite that?
Yeah, so we're going to look at the blended average acquisition date of the total portfolio. So we'll look at, so if it's 10 properties and 8 of them were purchased 2 years ago and 2 were in the last 6 months, the blended seasoning on that is going to be exceed the 12-month mark, right? So we'll be less concerned about the loan to cost unless we're talking about, crazy appreciation, which we're not really seeing that much of anymore. And we're going to look at the cost basis as not just purchase price, but purchase price plus all the rehab dollars, all the things that the sponsor has put into the properties in order to increase value in what they've invested in, right?
Right.
So we're going to use as is value and the total cost basis, but we'll look at that blended seasoning. So it's an average seasoning.
Okay, that's good to know. And you mentioned this before, the limitations in regard to regionality of the properties, if that's a word. But as far as where the properties are located, could you do a set of properties in, say, California and a set of properties in Florida and put them under the same blanket? Or are there any limitations?
Yes. No, we can absolutely do that. There's a couple things that people should be aware of, and what ends up happening is we require a new Delaware LLC as the borrowing entity to be set up exclusively for the purposes of our blanket loans for that portfolio term loan. And what that means is then the sponsor would have to register the entity in both of the states in which it's owning those properties. So there's a little bit of extra cost associated with that. And on very large loans, once we get above the 5 million mark, there's some legal stuff associated with legal opinion letters on the enforceability of the various loan-related documents for each state. So sometimes it just doesn't make sense to do, 1 or 2 properties in a specific state when you have to get those opinion letters. It just happened with me, actually, where we financed properties in 4 states, and it was California, North Carolina, Georgia, and Virginia. And it was a large loan, and they were going to have to get those legal opinion letters, and it just didn't make sense to have the 2 properties in Texas also included there. I think it was Texas and Oklahoma. There were 2 properties in each of those states. So we kind of carved those out for now because they're growing their presence in those respective states. It'll be better to just do those later. So it works to do the California, Florida. That's less of a problem. But when you're talking about 4, 5, 6, 7 states, it can get costly.
Sure. And you could, in theory, you could do those as one-offs with your other program, the single loan program.
We could. The single loan program is full recourse, though, and so sometimes what's very attractive about our portfolio term loans is that we offer a non-recourse option, which is helpful. There is a carve-out guarantee, of course, but it's for bad acts and a couple other lender carve-outs, but the other loans are full recourse.
Okay. Oh, that's great. That's great. So you can do non-recourse. You also have a full recourse option in the portfolio as well, right?
We do. And so if someone is willing to sign a personal guarantee, this is for loans that are under $4 million. We can give a little bit better pricing. Those are one of the levers that we can pull related to rate.
Okay, super. And so again, I know you mentioned this, but I just sort of want to hammer this home. You can do a blend of different property types under one portfolio, i.e. do a multifamily, and then some single families, some duplexes, whatever it is.
Yes.
It will all fit as long as you go into those loan value per door minimums.
Yes.
And you hit the 500 minimum total loan.
That's right. Yep.
It's not too big of or not too small of a target to hit, actually. So
no, so it can be a combination of a whole bunch of SFRs, right? Just standard one single SFR detached houses. It can be a combination of a few of those, some duplexes and triplexes, throw in a 6-unit. However your portfolio is comprised, we can typically get there. We can even include, especially in kind of urban infill locations, small mixed use. And what I mean by that is the ground floor might be a retail unit or office space or something of that nature, and then up above are residential units that are rented, like you see in Philly and some more urban locations. We can even often include those in the blanket refi with kind of your other properties.
Very interesting. Okay.
Mm-hmm.
Okay. So, and I know the advantage here, and if there are others that I'm not thinking of, but the main advantage here is, especially if we're going into a rising rate environment, which potentially we are,
mm-hmm.
you're kind of taking your whole set here, locking it in for a long period of time. Your cash flow is there. It's very stable. It's a great loan program. Why else do people do these portfolios? I mean, what's another advantage there?
Yeah, I think it's an administrative advantage, right? That there's, it's one loan payment instead of you have 30 properties or more, or 10 or more, 5 or more, you're having to manage sort of 5 mortgage payments, right? Versus one. Same thing, we impound or escrow for taxes and insurance. And so that's paid for through the servicer. So I think there's a good way to sort of simplify things by bringing your properties all together in one loan. I also think people want to free up some of that capital, right, to go buy more. So if you're at a low leverage or you purchased all cash, it's a great time to sort of refinance, extract some of the equity that you may have embedded in the portfolio, and then not to plug me, but, do a credit line with me so that you can go buy more properties and build that portfolio, stretch the proceeds from the refi a little bit further using leverage on the short-term side.
Yeah, I like it. That's exactly, no, that's it. That's what we're here for. So, all right, well, what else would you like to say about any of those programs? I don't know if I hit every button here, but is there anything else we should talk about before we kind of move on here and then get this wrapped up?
Yeah, I think one other thing about the portfolio loan is that while we typically do the 30-year AM, in the event that an interest-only structure is something that makes more sense based on the cash flows of the properties, that's certainly something we can do. It's just going to be at lower leverage, more like 60 or 65% max leverage on an interest-only, but that option is actually out there. So I wanted to mention that.
Oh, that's awesome. And I did have a question going back to your the rehab.
Mm-hmm.
Do you or will you consider any ground up construction in that program, or is it just all rehab?
Yes and no. For really seasoned folks that have done it before, we will consider ground up primarily as build to rent. We're not a home builder financing shop. Have we done it from time to time in very specific scenarios and certain markets? I am thinking places like the Bay Area where there's a builder who's buying properties, bulldozing them and rebuilding sort of more in line with what that market will bear and the demand up there. But in general, we're not doing a ton of ground up. We will do it, though, from time to time, especially with someone that knows and has the experience. The build to rent piece, and you may have seen it out there, we refer to that program as build to rent complete, where we'll finance the vertical construction on a 1-to-4 that's going to be then held as a rental, and in the hopes that we're getting the refi on the rental takeout, right? Or multiple properties in a subdivision, for example, that are going to be built for the purposes of renting. And then we can do the refinance into that portfolio term loan once those properties are completed and leased. So that's where we can do some of that ground up.
Okay. Again, that's a hidden little gem of a program that I know we've gotten calls for.
It's neat. Yeah, it's neat. And I've worked on several of them. In my previous capacity with running the bridge business, I spent a lot of time sort of working through how do we structure that. And then since I've departed, the team has really built that out even more. But I have anywhere from a 18 unit to a 60 unit development right now for that build to rent program, kind of in various stages.
Wow, that's awesome.
Yeah,
okay.
Yeah, it's neat.
Yeah. So, all right. So let's. So tell me, just kind of in wrapping up here. Well, I want you to tell that story about what you did just recently. You got a little bit of fame there, I think.
Oh yes. I'm living vicariously through a relatively famous person.
So what happened there? Because I was going to ask you some questions, but I decided to hold off until we actually started.
Sure. Yeah. So was doing a little bit of research and had sort of a list of prospects, and the gentleman from the HGTV show Flip or Flop, Tarek El Moussa, was on my call list or on this list, and I thought there's no way I'm calling, him, because he's not going to answer the phone. So, but his CFO was also, I figured out who that was. And so I cold called them just to introduce myself and see if, they had any need for financing on the short-term or long-term side of things. And turns out not only do they flip a lot of houses, but they own a lot of rentals. And in February, I closed a large rental loan with them on 54 properties across the country, and got to have a great dinner last week. It's out there on LinkedIn right now with them. So a lot of fun, neat guys, and a little bit of 2 minutes of fame for me.
Well, I mean, I think the courage to pick up the phone and call somebody like that takes some.
Well, it's a joke now. Pete and I joke around because he answered the phone, and when he answered and I said who I was, he made this sound like, oh, I can't believe I answered a phone call from someone I didn't know, and this is what it is. And so we've had a laugh that, and at the time they weren't ready. It was over the summer. They weren't sort of in the position, but I happened to be down in Orange County, and we met for coffee and just kind of kept talking and hit it off. And I mean, without having reached out, I wouldn't have known that they even really had a rental portfolio.
Well, I mean, I think to me, like what that really shows is you watch a show like that and you think, well, they have it all figured out. Of course they have their lender and they have money, or they're not using a lender or who knows what, but you would just sort of naturally assume. And I am always amazed at how valuable you are. Like here you are, you show up and you're bringing some new value to these people that wouldn't have known probably where to go or that maybe that this program even existed. I mean,
and they have a lot of resources, on the short-term side, and I think like people kind of know that they are doing a lot of the flipping stuff. And what's interesting, I think, about a lot of customers, and this isn't specific to this group, but what I've learned in my sort of years in real estate is that many people who are really, really good at flipping or residential investing and so forth, and they've amassed, pretty sizable portfolios and bank accounts, right? That they've been financing this stuff through sort of country club money. And what I mean by that is it's friends and family money. It's the private wealth line of credit that they get from their private wealth banker, right? It's not necessarily institutional capital or institutional debt. And it's a different ball game, but in order to grow really grow, at some point you have to make the leap. And our loans are really institutional in structure, and it's an education. And I think I'm always impressed by the guys that say, like, this is what I want to do, and help me figure out how to do that. And our loans can often be kind of the first step in that. And I don't want to, it's a conversation I have a lot with small guys and really big ones that they're awesome at this piece of it, but not necessarily the financing piece.
Exactly. That's a great point. And it's very, very prevalent out there. So hopefully we have a small slice of the answer here with the podcast, and, kind of dissecting and demystifying the whole realm of capital and what's out there. And, I really appreciate you being here today. I love working with you, and
likewise. We have fun. Yeah. It'll be good. I think I'm excited to get our deal closed and do some more.
Yes. All right. Well, great. Well, anything else you want to say before we wrap this up?
No, I don't think so. Just thanks for putting me on the spot. It's been fun.
You're welcome. That's my job. No, you
awesome.
No, so all right. Well, thank you, Stephanie. And
yeah.
I'll talk to you very soon.
Okay, sounds great. Thanks, Lane.
All right, bye-bye.
Thanks for listening to Real Estate Investment Finance Radio. We know this has been enlightening for many of you. If you want the most current, updated information on the dynamic real estate finance market and would love to learn more about how you can get direct access to many more sources like the one you just heard from, please visit our sponsor at capconnectnow.com now for instant and direct access to the best source for your specific needs. That's capconnectnow.com, C-A-P as in Papa, the word connect, and the word now, N-O-W.com. Thanks again for listening to Real Estate Investment Finance Radio.